The select few who bought their homes in early 2022 may find that they are, unfortunately, upside down on their home's value right now. Home values dropped 13% between June and December, leaving many buyers kind of waiting on the sidelines even today, wanting to buy, but worried or maybe hoping that values will keep dropping. And that begs the question, how can you know when it's the right time to buy? All right, have you missed your chance at rock bottom prices? Or is the carnage still to come? Well, that's what we're going to talk about today. We're going to talk about exactly which metrics you need to be watching to predict where interest rates are headed. Next, we're going to check in with the experts to see if we're actually seeing those things happen right now. And of course, we're going to take it local. With inflation reports and bank failures, how is this affecting the Dallas housing market? Okay, should you be getting out your checkbook right now? Or is the worst still to come? Well, hello, this is Wendy Pennell, and if you're anything like me, you've probably laid in bed wondering when prices will bottom out in Dallas. Well, if you're gonna stay up at night wondering, you might as well know what to wonder about. So here it is. What you wanna look at in the market are actions that will drive interest rates, okay? The one thing that has been effective at slowing buyer demand and driving prices down in Dallas has been those higher interest rates, shutting down affordability. So what affects interest rates in the housing market? Well, if you just answered the Fed raising rates, you're wrong, okay? You're wrong. It's much more complex than that. The Fed's actions play a key role in affecting interest rates, but rates are driven by inflation, they're driven by the bond market, they're driven by market sentiment, and yes, they're driven by the Fed's actions. But all of these factors are interwoven and they play off each other. It's quite possible for the Fed to raise their benchmark rate and have interest rates go down, again, because the Fed is not the only influencer here. In fact, it could very easily be argued that inflation is what drive interest rates, okay? Everybody's watching inflation and you should be too, okay? If you wanna get a fantastic deal on a house, you need to watch inflation. All right, now these are the metrics you need to have your eye on, okay? You wanna look at the personal consumption expenditures index, the consumer price index, and you wanna be looking at employment, okay? New jobs. Now, if your goal is rock bottom prices, no matter what your interest rate and monthly payment are, it's all about the prices, then you wanna see those metrics going up, okay? Because if they go up, it shows inflation is still high, okay? So high inflation is going to trigger the events that cause interest rates to rise. If you're in the I want rock bottom prices camp, okay, you'll want to be seeing these metrics go up. Now, you may have a completely different goal. Your goal may be affordability. And I can tell you right now, when prices hit rock bottom, that is not gonna be when homes are most affordable. Now, and I realize that probably seems counterintuitive, okay? But interest rates are what make the difference in affordability. And Zillow points this out as well. They say falling rates are far more helpful for affordability than falling home prices, okay? Rock bottom prices are going to come when interest rates are at their highest. But even though the prices may be rock bottom low, you're still gonna end up paying a higher payment because of the interest rates. So if affordability is your goal, you wanna see interest rates come down, okay? So you wanna be watching for those same metrics to be coming downward, okay? You wanna see PCE, CPI dropping, right? You wanna see no new jobs. And believe it or not, when you're falling asleep at night, you find yourself like sort of hoping for a recession. And that sounds really bad, okay? But basically when inflation comes down, interest rates come down with it, okay? And I can tell you right now, okay, this is what realtors want, right? Because we know affordability will help the market. Now that you know what metrics to watch for, what is going on with the market right now, okay? What are the inflation measurements telling us? Where are interest rates headed, okay? Well, thus far, we've seen a lot of turbulence, okay? And a lot of surprises. When January numbers were released in mid-February, it was bad news across the board. I mean, I guess it could be good news depending on your goal, right? Well, PCE, CPI, and employment all went up. Okay, Andrew Kelly explained that the personal consumption expenditures tracked by the Fed for monetary policy shot up 0.6% last month after gaining only 0.2% in December. Not only that, but Alicia Wallace observed that consumer spending did too, okay, showing the continued strength of the U.S. economy and that rising prices won't be so easily defeated. Now, in terms of CPI, Jeff Cox reported that inflation rose 0.5% in January, more than expected, and up 6.4% from a year ago. Okay, he continued saying, January's data shows inflation is still a force in a U.S. economy in danger of slipping into recession this year, despite Federal Reserve efforts to quell the problem. Now, we also need to look at job increases, right? So to look at that, we have to look at unemployment, and you need to know it's measured in two ways. The business survey revealed 517,000 new jobs, and the household side came in at a whopping 894,000 jobs. This caused the unemployment rate to drop from 3.5 to 3.4%, the lowest number since 1969. Okay, so that was January. Now, as of mid-February, we had strong jobs report, right? And higher than projected CPI and PCE. And so the experts, they really were not optimistic, okay? Oscar Munoz reports we currently expect 2 more rate hikes, but the risk is towards even higher rates. The labor market remains strong, and it's going to take a bit more time for it to start showing signs of deterioration. Jeffrey Roach, chief economist at LPL Financial, said clearly the risks are rising that inflation will not cool fast enough for the Fed's liking. Okay, so keep in mind, again, as long as inflation numbers are high, chances are mortgage rates are going to go higher, and that's exactly what happened. And remember, if rates go up, the general result is that people can't afford houses, so prices are going to come down. February's numbers mostly reinforce these same sentiments. Okay, CPI and unemployment numbers were released with nothing that would significantly change market sentiment. Okay, the consumer price index came in at 0.4, slightly down from January's, right? And the general response was, hey, that's good, but it's not enough. Okay, still the market is still too inflationary. The jobs report was released, and Jeff Cox reports that job creation decelerated in February, but was still stronger than expected despite the Federal Reserve's efforts to slow the economy and bring down inflation. Okay, so he goes on to say that the unemployment rate rose to 3.6% above the expectation for 3.4%. Now, Aaron Terrazas, chief economist at Glassdoor, made this very insightful comment. Okay, he said it's no longer accurate to say without reservation that the labor market is a bright spot in the economy. He continues, from 35,000 feet, the picture still looks sterling, but digging an inch beneath the surface, there are clear pockets of softening. That same day that this article with his quote in it was published, while everyone else is still focusing on inflation indicators, we began to see an unexpected crisis of bank failures, okay? One after the other, okay? We began to see banks taken over by the FDIC, with the first being Silicon Valley Bank, okay? So all of a sudden, that sort of changed everyone's perspective. I mean, literally in 1 week, everyone's predictions changed, okay? And this is why it's so important to be aware of the market. If you're wanting to be strategic when you buy, okay? Got to be aware. Michael Gapin, Bank of America's chief U.S. economist, commented that our outlook for monetary policy is always data dependent, but at present, it is also dependent on stresses in financial markets, okay? So yeah, that would be, putting it mildly. Elizabeth Butchwald chimed in that it's been a tumultuous few days for banks. Okay, she continues, Silicon Valley Bank announced it had suffered a $1.8 billion loss and urgently needed to raise more capital. And it wasn't successful, okay? SVB failed to raise the capital it needed, and the Federal Deposit Insurance Corporation took over the bank, okay? This was a very alarming development because the bank's failure marks the second largest in U.S. history after the 2008 demise of Washington Mutual. And honestly, this bank failure had the potential to be catastrophic to the economy, okay? The FDIC insures up to $250,000 per account holder in the event of bank failure. But many businesses had millions of dollars in Silicon Valley. If they lost those funds, they wouldn't be able to pay their employees, okay? We would have seen massive unemployment, okay? This would have shuttered the whole inflation problem in a really ugly way, okay? Not to mention, if you think about it, the general fear it spreads throughout the public, right? Okay, people would feel like their banks can't be trusted. I don't think I need to tell you what would happen if everybody suddenly decided they needed to withdraw all of their money from the bank all at once, right? Well, the Fed realized this, okay? Elizabeth Buchwald says the Federal Reserve, Treasury Department, and FDIC announced that SVB and Signature Bank's failures posed a big enough risk that it merited allowing regulators to take the step of guaranteeing larger deposits, okay? She continued that in addition, the Fed will provide financing by offering loans of up to a year to eligible banks, okay? And they went on to explain the move is intended to prevent bank runs that would threaten the stability of the banking system and the economy as a whole. Now, it's important to point out, had the Fed not intervened, okay, with insuring all these depositors, this would almost certainly have triggered a turning point for the housing market, and interest rate hikes would have come to a halt. Okay, that's not what happened. Okay, the Fed did insure the depositors. So let's go ahead and see how the experts responded. All right, well, Michael Gapin, Bank of America's chief economist, says if the Fed is successful at corralling the recent market volatility and ring fencing the banking sector, then it should be able to continue its pace of rate hikes. All right, Alliance SE also had some excellent insight. Okay, they said elevated price pressures and a resilient economy prompted Fed officials to strengthen their hawkish rhetoric in the past few weeks. However, they continued, the big however, the SVB failure suggests a turning point in the monetary cycle. Interest rates have reached a level sufficiently high to trigger a recession. He continues, this should alleviate inflationary pressures markedly by the end of the year. So how is Dallas responding to the economic roller coaster? Well, we saw a volatile year in 2022, right? Okay, home prices shot up between January through May, and then they just dropped just as quickly the second half of the year. So year over year, most areas in the Metroplex kind of showed like either zero or just kind of nominal gains. Okay, and Dallas Morning News reports that the median price of a single family home in Dallas-Fort Worth was $380,000 in January, up only 4%, okay, from a year before. And their point really was, okay, that this is a noticeable departure from the double-digit percent increases seen through most of last year. Now, they also share how sales prices have declined 13% from last year's peak of $435,000, according to the latest housing market report. And I should tell you, despite all of this, right, the Dallas market is still trucking along. In fact, let's get our feet on the ground just a little bit here. I want to compare median sales prices in the 6 main counties, okay? Let's start with Denton County. In Denton County, in January 2022, we saw a median sales price of $420,000. In February of 2023, we saw a median sales price of $425,000. So you see already that just kind of that nominal gain. In Collin County, in January of 2022, we saw a median sales price of $465,000. In February of 2023, we saw a median sales price of $485,000. All right, moving on to Dallas County. In Dallas County, in January of 2022, we saw a median sales price of $315,000. In February of 2023, we saw that median sales price become $345,000. Then in Tarrant County, in January of 2022, we saw a median sales price of $327,000. By February, we're seeing a median sales price of $339,945. Moving on to Rockwall County, in January of 2022, we saw a median sales price of $390,000, and then by February of this year, we saw a median sales price of $415,000. And finally, in Ellis County, we saw a median sales price in January of 2022 of $377,923. February of this year, we see a median sales price of $374,900. So of the 6 counties, 5 saw an increase in median sales price year over year. Okay, now that may not have been what you were expecting, right? Interest rates are at 6.5%. So why are we seeing increases? Well, seasonality and demand are in a tug of war with interest rates and affordability. Okay, so from a purely seasonal standpoint, Dallas is very predictable. Okay, January is always the lowest month of the year. February is typically slow, and then the spring and the summer tend to be very strong. Okay, in the fall, things generally slow down, which turned, last fall into a complete slaughter fest, right? Since the Fed decided to mega raise rates right at the same time. Now, typically, we would see strong price movement in the spring. And so you can see interest rates are definitely putting a damper on things, okay? Still, the prices aren't going down. They're kind of more or less just holding their own or going up just a little bit. So that gives you an idea of the here and now in Dallas in terms of market activity, okay? But what can we expect moving forward? Well, if we continue to see the same pattern we're seeing now, okay? Seasonality and demand will duke it out with interest rates and affordability, okay? So probably gonna see like nominal appreciation over the next few months, if at all, okay? But let's check in with the experts and see what they have to say kind of, in light of all the new developments that we've seen in the economy, right? Well, Alliance calls for another 25 basis point hike in the May meeting, which will cement the Fed's anti-inflation credibility credentials. So isn't that nice that this is just all about their credibility? Very nice. They say the Silicon Valley Bank failure reinforces our view that the U.S. economy is headed for a sizable recession during the second half of this year. They continue that the recession-induced fall in core inflation in the second half of 2023 will allow the Fed to pivot in November through December. Now, finally, they conclude with the news we all want to hear. We expect a 25 basis point cut in November, followed by a 50 basis point cut in December. Okay, so if that's the case, we might expect to see Dallas home values kind of propped up by seasonal demand over the spring and the summer, but then they might be reinforced with rate cuts in the fall. So the big question is, okay, is Alliance alone in their prediction? Well, with today's rates at around 6.5%, Greg McBride, chief financial analyst at Bankrate, says we should expect mortgage rates to yo-yo up and down in the first half of the year, okay? Then he goes on to predict 30-year fixed rate mortgage rates will end the year near 5.25%. Zillow Research also checks in. They say home prices nationally should bottom out in 2023, then return to a more normal growth rate. They say affordability challenges are still dragging down demand for homes, right? Okay, that would be that same tug of war effect, right? You know, of seasonal buyer demand versus affordability. However, they continue that starting next year, the panel foresees price growth picking back up at an average clip of 3.5% per year through 2027. In Zillow's mind, home prices are going to be sluggish throughout 2023 and then pick up in 2024, okay? And if you think about it, that would tend to coincide with what Alliance is predicting, okay? Because if rates begin dropping at the end of 2023, we would anticipate price growth to pick up in 2024. Now, in regard to the interest rate question, you know, like when are interest rates going to come down? Okay, economists and housing experts polled by Zillow responded that the panel expects mortgage rates to trend downward after the first quarter. Okay, Zillow reports that when asked when rates for 30-year fixed loans will be highest between now and 2025, nearly 2/3 of those surveyed pointed to the first quarter of 2023. So overall, when we check in with these experts, they're projecting interest rates are the highest they're going to be right now, that as we work our way towards the end of 2023, we'll begin seeing rates drop. Now, this isn't the story we were hearing in February, okay? But these bank collapses have really just kind of brought on a huge shift. So we've talked about where the market is and where it's headed according to the experts, right? But how about our original question? Have prices hit rock bottom, or is more carnage still to come? Well, the experts are saying 2 more rate hikes, then they're predicting lower rates by the end of the year. Okay, but that's not the song they were singing in February, okay? At that point, they were saying to plan on more rate hikes for longer. But I think what's happening is we're seeing cracks in the dam now, okay? And I think that has just really changed the rhetoric. All right, we also know that from a seasonal standpoint, okay, this is typically a time of high demand in Dallas, okay? But how will that demand stand up to 2 more rate hikes, okay? I think that's gonna answer our question of what prices will do, okay? It's very much a tug of war between these two forces. If rock bottom prices are your goal, if the experts are right, it's possible we're already there, or that we may be there within the next few months, okay? Because once rates begin to go down, prices typically begin to go back up in Dallas, okay? And I know this is not the answer we want to hear. It's not the answer I want to hear. And I can hear right now the affordability camp screaming loud and clear, Wendy, we have an affordability crisis and prices are not going to go up. I agree. Okay, we have a big affordability problem, okay? But what you have to realize is interest rates are what will effectively improve affordability, okay? Mathematically speaking, it takes very little movement, you know, just a point, okay, to bring the same affordability that it would take for prices to drop by 11%. You know, so let's say you want to see your monthly payment improve through prices dropping $100,000, and doggone it, you're willing to wait until that happens. Well, what you need to realize is that before that ever has the chance to happen, the Fed will intervene by lowering rates. Rates are more powerful at improving affordability, and with the dam breaking, okay, we're gonna see rates dropping. Now, if we lived in an all-cash world, okay, where monthly payments weren't controlled and manipulated and whipsawed by the Fed, we'd be in a different ballgame. Now, if affordability is your goal, okay, it's just about the monthly payment, watch for those stressors in the market and watch for those rates to go down. Now, only you can decide how low rates need to be. In January, many buyers re-entered the market when they could get a 5% interest rate, okay? Something for you to be watching is, okay, the larger the economic calamity, the deeper the recession, the lower you can anticipate rates dropping. Okay, now just remember though, you're not the only one, in your weight. Okay, and low interest rates in Dallas are going to bring back bidding wars, like we talked about, no inspection, offering over bid price. Okay, now if affordability isn't the issue necessarily, okay, that this is more about equity, wanting to see, not wanting to buy and then see values drop further, you just want to make sure you absolutely get the rock bottom price. Okay, you will want to enter the market while rates are still high. At this point, that road seems to be laid out. That seems to be what the experts are saying, right? That they're going to see lower rates by the end of the year. The funny thing is that just a month ago, they were saying higher rates for longer. Okay, so it's those bank failures that have brought such a change in predictions. So our prices bottomed out in Dallas. Okay, the experts do seem to think that that's going to happen in 2023. Okay, and I don't like that answer. You don't like that answer. Okay, we want to see price drops that will improve affordability, but that's not what we're seeing predicted. Okay, and nor is it what we're seeing really playing out in the market. But I can tell you this much. Okay, we at home in Dallas, we're constantly going to keep you updated. Okay, which, side note, sounds like a good reason to subscribe, right? Now, as you're monitoring the market, this is something I want you to keep in mind, okay? I want you to keep in mind the power of the motivated seller. So think outside the box, all right? You may not need the market to bring you to rock bottom prices. You may be able to get there just by finding a desperate seller, okay? So in fact, if you want to find steep price drops, okay, I made an entire video about the most motivated, desperate builders in Dallas that you can watch right here. In the meantime, Wendy out.